Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News 9, where we bring to you the lowdown of the day's action on the Lal Street. Now, Indian markets continue to face selling pressure for the third consecutive day on January 18th, with the headliners breaching crucial support zone in the sharp fall. Now, on Thursday, which is also the weekly FNO expiry for Nifty, the markets opened gap down and witnessed fierce selling pressure in the morning trade itself. However, after making an initial low of about 21,285 on Nifty, bulls did try to make a comeback and momentarily took the index beyond the 21,500 mark. However, the momentum soon fizzled out and the index traded pretty much in a 100-point range from there on, taking support near the 21,400 mark on the downside, but also facing resistance around the 21,500 mark on the upside. Now, at close, Nifty was down about 0.5% at 21,462 mark. The index now has formed a spinning top kind of a pattern on the daily charts, which indicates undecisiveness between market participants. On Nifty, this was also the lowest close for the index since December 26, and now Nifty on a year-to-date basis is down about 1.3%. Remember, yesterday we turned negative. For the year 2024, we have in fact extended on those losses, and for the month and for the year on the whole, we are down about 1.3%. According to experts, the immediate resistance for the Nifty now sits at 21,500 mark, which was also the level of resistance, level at which we face resistance throughout the afternoon trade. And it's also a crucial psychological level. If the index does manage to be, move past that 21,500 mark, then we could see some bit of a resistance build around the 21,600 mark, and then the 21,645 mark, which is the 20-day moving average. Remember, it was a crash below this 20-day moving average that resulted in that big fall that we witnessed late afternoon in the late morning session from yesterday. Now, the 30-share Sensex on the other hand settled about 300 points lower at 71,186 level. This was also the lowest close for the index since December 2023. Now, moving on to the broader markets, the price action was quite interesting there. Both indices opened mildly higher, but this soon witnessed some bit of a selling pressure take place, and at one point both were down about 2% or so, with the small cap index particularly breaking below the 15,000 mark in the morning trade for the first time in 2024, and for the first time I think since December 28 of 2023. But then we also saw a sharp recovery, and both indices managed to settle close to their day's high. Now, as you can see on your screen, Nifty mid cap 100 was down about 0.11% and it settled just marginally below the 47,100 mark, and the small cap 100 index, which as I mentioned earlier saw a dip below 15,000 levels, was able to rise about 350 points from the day's low and settled somewhere around the 15,320 mark. Now, India VIX, the fear index, saw a big intraday dip of over 6.7%, and that index has settled about at 14.07 levels. Now, today, as we know, there was a weekly expiry for Nifty, so perhaps the contracts have been settled, and we can assume or hope for some bit of a decline in volatility, at least for the next few sessions. Now, let's talk about what led to today's fall. The sharp correction first was seen once again in HDFC Bank. Now, remember, ever since the result came out, the stock has been on a falling spree, and in the last two sessions alone, it has wiped out about 11% of the investors' wealth. Now, the street pretty much was disappointed with the December quarterly results, and particularly the outlook on loan growth and the margin was something that led to downgrades from brokerages as well. Now, as we know, HDFC Bank overall has a 14% weightage on the index, and a sharp correction in HDFC Bank is one of the leading reasons for the market's recent underperformance. Another pocket of the market that roiled the sentiment was the tech stocks, and remember, just late last week and early this week we were talking about a rebound in Nifty, IT, and how they were joining the party, but the IT index on the whole fell about somewhere about 0.5%, and the biggest drag was LTIMindtree, which crashed by nearly 11% in today's trade following a miss on its Q3 results. Now, also apart from the local factors, there are some global factors as well. There is a global risk off sentiment that has led to a correction in most equities, across major equity markets, especially the emerging market basket. This was on the back of US Federal Reserve Governor Christopher Waller's recent comments that a pivot in the monetary policy may come slower than anticipated previously, and that is pretty much haunting the investor sentiment now. Following the hawkish remark of Governor Waller, investors are now skeptical that Federal Reserve, if they'll go for a rate cut as early as March. Expectations, at least as far as we understand, have now shifted for a cut to June, and as hopes of a rate cut in March has begun to fade, the yields on the US 10-year benchmark treasury yields have also picked up, and they have reclaimed that 4% mark, and currently they are hovering somewhere around the 4.1% mark as we speak. The dollar index, now that has also seen a sharp spike over the last few days, and it's back above 103 sort of levels, hitting a 1-month high in the last couple of sessions. Now the spike has also negatively impacted metal stocks. Remember, there is an inverse relationship between dollar index and the metal index, because most metals are priced in dollar terms. So when the dollar becomes more expensive, it's more expensive for to buy metals in other currencies. So that's why, because demand perhaps could take a hit, and that's why we are also seeing a decline in the metal pack, which has fallen by about 0.5% or so. Let's talk about the other sectors as well. As I mentioned, Nifty Bank, now that has declined by about 5% in the last couple of sessions. We are at the lowest level since early December of 2023, and just a few days back we were talking about this time perhaps after rescaling that 48,000 levels we could make a move higher towards that 50,000 mark, but the results of HDFC Bank played a spoil sport over there, and the index has corrected sharply. In fact, has fallen by about 5% or so since then, and even today we have seen extension of those losses, and the index was down about 0.76% in today's session. IT, as I mentioned earlier, was also a big drag on the market. Remember, yesterday it was the only sector that had ended the session in the green, but today it once again started seeing some bit of a selling pressure after the disappointing numbers from LTIMindtree. Auto pack, now that was under a bit of selling pressure in the last 1 month or so, but today we saw some bit of a recovery taking place in the Nifty auto pack, and the index managed to end about 0.3% higher in today's session. FMCG has also been struggling, and we saw a cut of about 0.5% for Nifty FMCG after the disappointing results of Asian Paints, which again puts into question that recovery in demand taking place. Also, remember, back in when Asian Paints came out with the results, it said that it had to cut prices, and that pretty much compensated for that additional volume growth. So going forward, I think once the results of your big heavyweights start coming out, HUL, ITC, we will keep a track on how much that demand pickup that was expected, especially in Q3, because we have that festival and wedding demand also, which was also being factored in. So a very close eye and attention should be paid on the demand for the FMCG pack. But I made to believe Mr. Avinash Gorakshakar, Director Research at Profit Mart Securities, has also joined us. Sir, Mr. Gorakshakar, thank you for joining us here on News 9. Always a pleasure speaking to you. And I want to begin by asking about what are you making of this, sharp correction that we are witnessing in the market over the last couple of sessions. Now, is this a reversal of the previous bullish trend, or is the view still that, you should perhaps keep on buying these dips?
I think, Suresh, the bull run continues. I think what we have seen yesterday and today has been a little bit of an overreaction. Yesterday, HDFC Bank was down by almost 8 to 9%. Today, it was down by about 3 to 4%. So my sense is that, I think these are typical, profit booking kind of times when most of the stocks came under pressure. And I think, yesterday, the talk in the market was that most of the banking stocks could get derated. But if you see the performances of banks like, Ujjivan Small Finance Bank, or typically a South Indian bank, I think clearly even HDFC Bank numbers were not bad. I think what the markets were little disappointed was on the deposit growth, which could possibly compress its net interest margin going forward. But my sense is that the entire market is not looking bearish. I mean, this is definitely not a bear market. These kind of corrections and this kind of volatility is very much common in a market where prices have shot up significantly in a very short period of time. So I think we continue to be positive, on selective sectors, on selective stocks. On the broader index, I think one could see the market remaining in a close range because we believe that valuations on the index side have become slightly pricey. Even the overall valuation band of small cap, mid caps has entered some sort of an exuberance and a euphoric kind of mood. So I think you need to be careful on the valuations, and I think you now need to be very selective if you want to, make a reasonably good risk reward in the market. So I think net it's a buy on dip for good quality companies where the earnings commentary, where the numbers are pretty strong. And I think in terms of FI flows, in terms of SIP money, liquidity is quite comfortable. So to that extent, I think our markets are not going to be down for a very long period of time. In fact, today's market, if you observe, there's been a very strong recovery from the first half. In the second half, there was a very smart recovery. So
Right.
that clearly shows that things have settled down.
All right, and I want to spend some time on the broader markets and HDFC Bank also. But talking about this turnaround that we could perhaps witness in the next few sessions, is that around the corner, or can we see a little more correction because the sentiment overall, not just for the domestic market, for the global markets as well, has turned slightly negative now?
So I think it could take a little more time. See, because Suresh, you must understand one thing. Ever since the state election victory numbers came out, the markets have been on a tear. So I think what has happened is markets have shot up also very fast. We saw a rally of almost 2,000, 2,500 points on the Nifty. So I think we would be seeing some consolidation. We would be seeing that the markets would remain either stagnant or steady. Another mood of re-rating would not happen till the time, possibly the final election numbers are out by May or June. So typically, I think, you will probably have to focus on companies, good stocks where earnings numbers are going to be pretty strong. I think that is how the markets would, obviously reward stock pickers more in this kind of market. But yes, I think large caps now appear to be a little more attractive considering the fact that small and mid caps have rallied significantly. So I think it's going to be a pick and choose in the market. So I would not be surprised that despite a sluggish index, could be many choices in the broader market, which I think investors should now watch out.
All right, and I want to talk about the broader markets because quite a interesting session we had. We opened slightly higher, but then soon after the pocket, the mid cap and the small cap both succumbed to profit taking. They dipped by about 2%, but a very strong recovery in the second half. In fact, both indices managed to end near the day's high. So what are you making of this overall movement, or is this just a rejig that is taking place between sectors and between themes in the broader markets?
Yeah, I think, Suresh, you must understand one thing that, and you'll agree with me, that the market will not fall twice on the same news. Yesterday, it was the banking sector. I think today, most of the banking sector stocks have stabilized. If you see the PSU bank stocks, they were all doing well. In the private sector banks, stocks like ICICI Pru, which of course is not a banking stock, but an insurance company, numbers were horribly bad. So you could see a down circuit there. In fact, from the manufacturing side, you saw very strong numbers from Polycap. So I think the markets are rewarding good numbers. In fact, Oracle Finance was up by almost, Oracle Software, sorry, was up by almost 30%, by strong numbers. So I think the markets are now again focusing on data points, on numbers. So I think rather than the rejig, I think it's the earnings season, which has started. So I think markets are going to be using a microscope and looking at earnings numbers. Wherever the numbers are strong, sustainable, and where the management commentary is good, you could find definitely some positive surprises happening. But I think on the other hand, negative surprises, if they do happen, that is definitely not going to be liked by the markets, and we could see a little bit of hammering on the stock going ahead.
Now, Mr. Gorakshakar, we have been talking about how HDFC has been a big spoil sport and a reason for the big sell-off that we have seen in the last couple of sessions. But I mean, I was just looking at the FII data from yesterday and they pulled out nearly 10,000 crore from the Indian market. And I think what's more interesting is that it was not just India where they sold off, but other emerging markets as well, as Asian stocks saw an outflow of nearly about $5 billion or so. So what do you think is leading to this global sell-off in emerging market equities, sir?
Yeah, I think you must understand one thing that, US Fed has now clearly mentioned mentioned that rate cut expectation, which are going to happen from the month of March, may not happen. It may take another, say, 2 to 3 months. So that was one disappointing factor, which actually led to one reason for the sell-off. And secondly, of course, HDFC Bank numbers, as I mentioned earlier, markets are looking at the fact that the entire banking sector would now be looking at a deposit war. Getting deposits is not going to be easy. And coming year, that is FY25, could see a lot of pressure on the net interest margin of almost all the large as well as the medium-sized banks. So I think these two factors were something which markets did not like. In fact, the banking stocks account for almost 30 to 35% of the overall Nifty composition. So any kind of negative surprise or a major sell-off on the bank Nifty in most of the banking stocks led to a very big fall in yesterday's trading. But today, I think we have seen some consolidation happening. As you rightly pointed out, after the first half, the second half was a very smart session. The Nifty would recover its lost ground. And I think, after touching a low today, I think the Nifty has again consolidated. So I think clearly markets seem to be slowly inching up now. And of course, HDFC Bank continues to be in negative today also. My sense is that it cannot be presumed that all the private sector banks are going to be sold. I think banking are a very important component for most of the FIIs, for the domestic funds. So I think this is one area where I think we'll have to keep a watch for the next couple of quarters. If there is deceleration in the deposit growth, then that could be a matter of concern, and that I think would be a bigger point where markets could get more volatile, because if there's a sell-off on the banking sector, you could see the index going down at lower levels.
All right, and there is a very interesting theme that is playing out in the markets, the Ayodhya stocks, and I think I would want to bring on board Amit to tell us more about these Ayodhya stock theme that we are seeing playing out in the markets now.
Good morning, Suyash. Yeah, we spoke about what the market is calling the Ayodhya stocks. Now, these are the stocks that have been rallying for the last 1 year, ever since the momentum to the Ayodhya Ram temple has gained picked up. So I'll start with Apollo Sinduri, which is a hotel company. But in Ayodhya, what they are really supplying is parking space. That stock has been up almost 80% last 1 year. There's been correction. There's been a correction in the last 5 days, as the graphics will show. But that has been rallying. Next one is Pravej, which is providing tent house resorts on the ghats of the Saryu River, a place called Brahmakund. That has been rallying. India Hotels Taj has a proposed plan of their Ginger brand and their Vivanta brand to be opening hotels in Ayodhya. So that has seen a surge. There's been a correction in the last few days, but otherwise, the last 1 month and the last 1 year, all these stocks have been surging. Indigo, they have daily flights from Delhi to Ayodhya. That stock has been surging. Thomas Cook, that's another stock that has been surging in the last 1 year, almost over 100%. A bookings company. IRCTC, regular trains to Ayodhya, that stock has been surging. So these are what the market is calling the Ayodhya stocks. And last 1 year, they have all seen around 50 to almost 200% surges, depending on which stock you're looking at. Last 5 days, there has been a little correction, but it's on the upsurge.
All right. And Avinash, coming to you, anything between the 6 or 7 stocks that Amit laid out for us, anything that looks particularly attractive to you?
I think my sense is Indian Hotels and Praveg, which your colleague mentioned, look pretty interesting, because see, Indian Hotels is putting up a hotel resort in Ayodhya, because obviously the traffic in Ayodhya is getting bigger and bigger. According to our estimates, in the next 1 year, that is, for the current financial year, you could see, tourists to the region of almost 4 to 5 crores. The temple is opening on 22nd of January. So I think there's a huge amount of, kind of euphoria, a kind of participation which is expected from the Indian masses. Obviously, Praveg has been into luxury tent resorts, and they have also put up a very large facility in Ayodhya, which is just nearby to the temple. I think your colleague rightly mentioned that these stocks have rallied, significantly in the last 1 month. So I think now at these levels, I would not be a buyer. But yes, any correction and any meaningful correction in, let's say, an Indian Hotels or a Praveg or maybe a Thomas Cook would definitely be, be looked upon as a good accumulation opportunity. In fact, any company which is connected with Ayodhya. In fact, Allied Digital, another company which we know, is involved with the smart city development of Ayodhya. So, that stock has also rallied quite significantly. Of course, aviation wise, Indigo continues to have the best, kind of synergy and advantage because it's got already a market share of 50% plus. So I think, the theme is going to be played out very well, but how sustainable this is. And in terms of valuations, I would say that it's always better to buy these stocks on declines. At these levels, I don't think you're going to make a lot of money here. So I think it's better to hold fresh buying only on declines.
Mr. Gorakshakar, I'll draw your attention to one stock which is providing a very unique service. Also, Genesis International, they are providing a 3D model of the entire city apart from satellite navigation. Now, that stock has only risen around 6% in the last 1 year, and over the last 1 month, there has even been a correction. What do you make of Genesis International? Is that a good stock to buy? Because that has not rallied that much. I mean, Pravej has rallied almost 215%, but Genesis not so much.
I think, see, all stocks which are related to Ayodhya are definitely re-rating candidates. And if you rightly say, Genesis has got the right triggers, you'll probably see the numbers, getting into the financials possibly in the coming financial year, that is for FY25. Genesis also did a preferential issue to some ultra HNI investors. So I think that also is a big positive for the company. So I agree with you that Genesis could definitely be a better re-rating candidate because, it's not participated largely as compared to the other companies which have operated under this theme. So I think one could definitely look at it from a slightly longer term kind of perspective.
Okay. All right. And as we speak, the numbers of IndusInd Bank have also started coming in, and they look to be slightly ahead of estimates. If we can pull up the numbers, the net interest income for the December quarter stands at around 5,295 crore versus 4,495 crore in the year ago period. Now that's about a 17-point jump in net interest income, and that is slightly ahead of what the street was expecting as well. And the net profit figure, that has also risen by about 17% or so. It comes in at around 2,295 crore for Q3 FY24 versus 1,959 crore for the year ago period. Now the numbers are just coming in, but Avinash, coming to you, any initial thoughts on the IndusInd Bank numbers, and also wanted to touch on the stock because that has been a clear outperformer when it comes to the private banking space. A lot of them have given negative return on a 1 year basis, but IndusInd Bank has given returns of about somewhere close to 30% or so.
No, I think you're right. IndusInd Bank has definitely delivered better numbers, and I think the market has rewarded it with a better outperformance in terms of its share price. I think if numbers for the December quarter are definitely good on the deposit side, Suresh, I think markets would get a sense of relief because that would mean that it's only related HDFC Bank kind of issue because deposit growth is going to be a big challenge. In terms of the asset quality, I would be looking at the slippage number. And I would also be looking at what kind of disbursals they have made sectorally. So I think IndusInd Bank definitely deserves a second look. But I think once the management commentary is out, we get a sense of what kind of outlook the management would share for the next 12 months is something which is very important. But I think the deposit number growth for this quarter as well as on a YY basis, I think would be a crucial number to watch because any slowdown there could mean the same thing what happened with HDFC Bank. So I think we'll have to wait and watch for some more data points to come out.
All right, and I want to stay on with HDFC Bank because as we have been talking about on this show that it has been a major drag on the market, and the numbers, as you also pointed out, they were not too bad. So what justifies that 11% sort of a correction that we have witnessed in the last couple of sessions?
I think there's no logical explanation, Suresh, for the fall. I think 9% fall for HDFC Bank in one trading session is something which was out of the territory of most of the fund managers or most of the analysts. In fact, most of the institutional analysts whom I have spoken, the target prices still range around 22 to 2300 rupees. So I think clearly, I think one will have to come to terms as to why this sell-off happened. But I think one thing is very clear. It happened on a day when the Fed commentary was negative. It happened when possibly the bond yields were also high. So I think let the water settle down. I would not be surprised that, now HDFC Bank stock seems to have settled down around 1450, 1500. some more time, I don't think you're going to see any further negative surprise on the stock price. Of course, incremental upside would depend on how they scale up their deposit kind of base. But otherwise, I think numbers have been pretty good. A 30% growth in profit, a 23% growth in the net interest income, asset quality under control. I think markets would like to see how they scale up their deposit growth, because in case that decelerates, then I think obviously there's going to be some pressure on their NIMs, which I think again the market would not like.
And Avinash, before I let you go, we are, I'm talking about HDFC Bank over here, we are in that range where, the stock had consolidated from between 1480 to 1520. So will you be a buyer at this price, or would you rather wait for some time and let the dust settle and, see some bit of a reversal in the sentiment?
No, I think around 1450 to 1500 Suresh is a very attractive level, and I think I would like to reiterate that this bank is one of the best professional teams which manage this bank. So I'm pretty confident that they could sail through this difficult period, and I think it's not something which is only common to HDFC Bank. I think deposit growth is a function of how swiftly money comes to these banks in terms of CASA deposits. So I think clearly it's not a one bank problem, and I think that is clearly a comforting factor. So I would be a buyer. I think the time frame I would look at is the next couple of years. I think 18 to 24 months you could get a decent risk reward, but I think you need to have a little more patience in this counter. In the short term, the stock may remain just range bound.
All right, the stock could remain range bound. Have some patience with HDFC Bank. That's the view coming in from Mr. Avinash Gorakshakar. Sir, always great insights from you. Thank you for joining us here on News 9. But that's all we have in this edition of Last Week. But stay tuned with us, as we'll be right back with Business Plus on the other side.
$20,000 people dead and counting. What's happening in the United States of America is unprecedented.